Yeah. So what we would like to discuss today, we have the S&P up for the fourth consecutive week. Now more than 20% off its October lows, which is like the technical definition of a bull market phase. Is that how you will look upon markets going forward, Harry?
Yeah, I mean, you can get all these kind of definitions, can't you? And I suppose the really key thing to think about is, well, what's next? Is it going to keep moving higher over the next few months and quarters? Because we really are in a new longer term uptrend, and we're in a cyclical bull market that's associated and driven by, an expansion in the economy and earnings and so on. Or is this just a very large relief rally? And are we about to roll over? And is the bear market still ongoing? That, I think, is the really key question. And it strikes us really that's going to be driven, that's going to be answered by liquidity, by the economy, by the earnings outlook, all of which I think is pretty negative certainly on a 12-month view. Of course, markets can squeeze higher in the near term, and there's a lot of excitement and there's a lot of frenzy behavior around AI and tech pushing markets higher. But actually, it's a very narrow move up in markets. The breadth is very low, and there's a lot of complacency and euphoria building. I mean, you look at Nvidia trading at 60 times forward earnings, and we see these kind of comments from people saying, well, Nvidia should be a bubble. A number of these AI stocks, they should be in a bubble. And you look at companies like Tesla up 60% or so just since the late April lows. So lots of single stocks where the moves have become very frothy, and that's typically what you get just before major local highs in markets. You get this phase of persistently strong risk-seeking behavior, and positioning becomes increasingly crowded on the long side. And then that's the top. So I think we're in that sort of blow off top type phase. The fundamentals don't warrant a persistent uptrend, a new cyclical bull market. The fundamentals are poor. So I think this is all about excessive positioning. It's about a little mini bubble in tech, which we struggle to see that it's got much longevity to it.
Yeah, I fully understand how you reason there, Harry. I mean, it looks like a major problem when we have these excessive valuations on the small group of companies, like a handful or maybe 7, 8, that are accounting for more than 90% of the year-to-date performance in the S&P and in the Nasdaq. So that's a fair point. I think when looking at earnings outlook, maybe we'll drill down a bit in how the economy looks in the US, both on the corporate side with the capex outlook that we've seen has deteriorated so far year to date, but also your views on the consumer in the US.
Yeah, well, I think the consumer is fascinating because there seems to be growing signs of weakness. And it's interesting, isn't it? Because when you move towards recession, the weakness always begins in the same places. Usually it starts in manufacturing and housing, because those are the most interest rate sensitive parts of the economy. And then it tends to spread towards consumption and services. And I think we're starting to see some of that spreading play out. So, for example, if you look at households, really, firstly, they've run down most of their spare cash. They had about $2.3 trillion in spare cash in 2021. That was the peak. We think they've probably mostly exhausted that, certainly as of the end of this quarter. When we get to the end of June, they'll have very little left, maybe 90 billion or something like that. So it's almost all gone. And the interesting thing with that is that the spending patterns are actually quite poor. People point to strong service sector spending, and of course, in real terms, that's right. Service sector spending's been trending up. But actually, if you strip out some of the non-discretionary parts of that spending on healthcare, spending on housing services, actually spending on services overall, once you strip those parts out, has been flat in real terms for about a year. So, there's clearly some pressure starting to build there. Credit conditions for the consumer are very tight. We think consumer credit growth is going to slow and roll over. There's a big pickup in delinquency rates as well, particularly amongst younger people. And let's not forget, house prices are beginning to soften. We think they're probably going to contract by maybe 10-15% year on year, something like that, given this very sharp fall we're seeing in transaction volumes, which is the best predictor of house price growth. So a fall in house prices, a negative wealth effect, consumer confidence is weak, the labor market's starting to deteriorate. There's a lot of weakness now starting to spread to the consumer, and that I think is the fascinating point. This is what will differentiate this environment from just a standard mid-cycle slowdown, a standard soft patch. This is what will mean it's likely, increasingly likely, why it's going to become a recession.
One thing that is a bit puzzling is that we have had like a 500 bips rate increase over the past 12 months, more or less, rough picture, and the market is basically unchanged. So the market could just take that sort of change in discount rate. Isn't that strange?
Well, it is, isn't it? I mean, markets are always forward-looking, and most of the weakness, we had a lot of weakness anyway last year, which was really, in our view, all about a major taper tantrum and the pricing in of an aggressive tightening cycle from the Fed. So, markets move ahead of these events, don't they? And they've since bounced, of course, because largely because positioning and sentiment became so overly bearish. But now, of course, the mood is starting to change, and markets have rallied. There's optimism is back. It's been the pain trade. This is markets going up. It's been, markets always find the path of least resistance, the path that causes the most pain, and that's what they've done this year. So, look, I mean, sure, they're pretty flat on a sort of 6-9 month view or whatever, but there have been some twists and turns to the story, and I suspect the next twist and the next turn will be a move lower in markets as we start to price in a contraction in the economy, a further contraction in earnings. Earnings have already just started to roll over and move lower. So very hard to believe that we get a multiple expansion in an environment of tightening liquidity as the Fed continues with QT, but also as the Treasury issues new bonds and sucks up liquidity that way, and in an environment as well where the consumer's weakening, service sector outlook is increasingly weak, and probably we're rolling into recession. Hard to imagine we get more multiple expansion in that kind of environment. So all of that, I think, suggests we're nearing a near-term top in US equity markets.
Yeah, I think that's a great way to end today's call, Harry. Thank you very much for your insights, and speak soon again.
Great, thanks for having me.